In this module, we shift from public crypto rails to bank-built blockchain networks. You'll see how players like JPMorgan use tokenized deposits and permissioned ledgers to move money, manage liquidity, and reshape cross-border settlement for large institutional flows. Institutions face a real dilemma in cross-border payments. On one side, legacy rails are slow, expensive, and opaque. You get batch processing, pre-funding, and long reconciliation cycles, but they're at least well understood and tightly regulated. On the other side, public blockchains promise near instant global settlement, but with open participation, uneven compliance standards, and unknown counterparties. Banks are effectively asking for a third option: the speed and programmability of crypto, combined with the control, governance, and assurance of traditional finance. Choosing rails for cross-border payments quickly becomes a decision between public and permissioned chains. Public chains are open networks. Anyone can join, deploy smart contracts, or hold assets. That openness drives innovation and global reach, but it also means pseudonymous counterparties, variable fees, and more external risk to manage. Permission chains invert that trade-off. Participants are vetted, rules are enforced at the network level, and compliance can be embedded, but reach and interoperability are limited to that walled garden. JPMorgan Coin is essentially a tokenized bank deposit. Think of it as taking dollars that institutional clients already hold at JPMorgan and issuing a digital version that moves on a private blockchain. Because everything stays inside the bank's ecosystem, funds can be transferred and settled instantly, 24/7, and reused throughout the day for intraday liquidity and treasury optimization. Tokenized deposits start with ordinary money sitting in a bank account. The bank locks that deposit and mints a matching token on its private ledger. That token isn't a separate crypto asset. It's a programmable on-chain IOU from the bank, fully inside the existing regulatory perimeter. Institutions can move these tokens instantly and embed rules like cutoff times or allowed counterparties. When someone wants cash back, the token is burned and the original fiat balance is released. Onyx Enterprise Ledger is JPMorgan's private blockchain platform for banks and large institutions. You can think of it as a controlled, permissioned version of a public chain, tuned for very high transaction volumes and always-on operations. Access is restricted to vetted participants, which helps align with regulatory expectations, internal risk controls, and the service levels large financial institutions require. Partior illustrates how large institutions are modernizing cross-border settlement together, instead of each bank building its own isolated system. It functions as shared plumbing for money movement between multiple banks and currencies. The idea is to move from internal, single-bank blockchain projects toward a global, always-on, multi-bank settlement network. Consortium governance is what you get when a group of regulated institutions jointly runs a network, instead of relying on a single owner. Participants share decision rights, agree on common rules, and can validate each other's behavior. Membership isn't open to everyone. It's controlled through due diligence. This model aims to balance decentralization with bank-grade compliance, control, and accountability. When you evaluate on-chain payment options, picture them along a control, innovation spectrum. On the permissioned end, bank-led networks prioritize strict access, privacy, and clear regulatory oversight. You know every participant, and governance feels familiar to existing banking models, but it's harder for new players or features to plug in. As you move toward public chains, you gain interoperability, open innovation, and global reach. The trade-off is less centralized control and new risk and compliance questions you'll need to actively manage. You can group most models into three broad types. Bank-led networks use tokenized deposits, so the asset is still a bank liability, in a tightly controlled closed group. Governance is centralized, but you get strong, bank-style settlement assurances. Vendor-led networks use a bridge asset. Access is limited to enrolled partners, and governance is shared between the vendor and participants. Public stablecoin rails use bearer tokens on open blockchains. Governance is the most decentralized, but regulatory alignment and counterparty comfort vary widely. When you assess an on-chain cross-border network, don't start with the cool tech. Start with business viability. First, strategic counterparty risk. If this provider fails, gets acquired, or changes strategy, how exposed are you? Second, regulatory and legal structure. Does the model fit how your regulators expect money to move? Third, operational factors. Will this actually improve speed, cost, and FX versus your current rails? And finally, access and coverage. Which corridors, partners, and customer segments can you realistically reach? The key idea is fit-for-purpose architecture. No single rail should win every cross-border use case inside your institution. For large same-day treasury transfers between your own entities, a permissioned tokenized deposit network like JPMorgan Coin might be ideal. For interbank FX liquidity, consortium or specialist networks such as Partior or Ripple can optimize spread and capital usage. For high-volume SME and retail payouts, public stablecoin rails or Ripple-style partners can prioritize reach, speed, and user experience. The future of cross-border payments is not either Swift or Ripple or JPMorgan Coin or public stablecoins. It's all of them, connected. You'll see closed bank ledgers serving large institutions, vendor networks stitching together corridors, and public chains providing global, always-on liquidity. Your job isn't to pick a single winner. It's to design how your institution plugs into multiple rails, manages interoperability and data consistency, and chooses the right rail for each customer, corridor, and risk profile. Tokenized deposits let you keep the familiar regulatory wrapper while gaining faster, programmable settlement. Consortium networks spread operational and credit trust across multiple top-tier banks instead of concentrating it in one. Your real task is balancing these options. Which rail fits each corridor, client segment, and risk appetite your institution actually has?